Hi, good morning. This is lecture number 2, week 2. We are still in topic 1. So, in the previous lecture, in lecture 1, week 2, I have explained about the financial statement. Okay, remember this. If you have a business, you want to know whether your business is making profit or loss in one given time. For example, in 1 year or in 1 month or in 3 months. So you want to know whether the business is making profit or not. If the business is making profit, then you are happy because you know that in general you can say that the business is performing well. If your business is making loss, then you are not happy because you know that the performance can be said as not well. So that's why if you have a business, it is important for you to know the profit of your business. So to know the profit of your business, you have to use accounting. The branch of accounting that you should use to calculate the profit is called the financial accounting. So now you are learning about financial accounting. So financial accounting, okay, just to refresh your memory, the definition of accounting is like this. A process to analyze business transactions and record business transactions and produce financial information. So the financial information is the accounting report. So like this, you have a business, every day you sell something, you purchase something, you pay something. So these are transactions. So when you use accounting, when you use financial accounting, you record everything. At the end of the year, you stop and prepare a report. We call it accounting report. This report will show whether your business is making profit or loss. In the report, the name of the report is financial statement. And in the previous lecture, you have seen that financial statement has 5 components. Income statement, balance sheet, statement of equity, statement of cash flow, and notes to the account. Okay, so the income statement is a statement that shows whether the business is making profit or not. And the balance sheet is a statement or a report that shows the financial condition of the business. So in this course, you will learn about how to prepare these two statement only, income statement and balance sheet. Okay, you have seen that. You can watch the lecture again if you want to refresh your memory. So today, in this lecture, you will learn about elements of the financial statement. Okay, remember again, financial statement is the report produced by the financial accounting. So you know the component of the financial statement. Now you learn about elements of the financial statement. Okay, let's see. Okay, there are 5 elements in the financial statement. First, if you open or see the financial statement, one element that you will see is called assets. Okay, so this is accounting terms. Assets means, the simple definition of asset is like this. Assets are resources owned by a business. Assets are resources owned by a business. So, if you have a business, your business will own many things. Okay, the things that are owned by the business is called asset. So the typical example is cash, inventory, account receivable, buildings, land, equipment, furniture, and maybe more. Okay, so let's say you open a grocery shop. Okay, you can imagine that if you open a grocery shop, you will have a shop maybe that is building. Maybe you own the land uh, where your shop is located. That is also resources owned by your business. So that is also an asset. And then in your shop, you have furnitures to display your product. That is an asset. It is owned by your business. And then in your shelves, there are many items like bread, sugar, and many more. The things that you sell, these are also asset. In accounting, we call these things as inventory or stocks. And then you will have cash. You will have cash in your drawer, and also you will have cash in your bank account. So cash also resources. Cash also is a resource owned by the business. So always remember, if you have a business or for a business, the resources owned by the business is called asset. Okay, another thing now. See here, cash, inventory, account receivable, and building. So assets can be divided into two categories: current asset and non-current asset. Current assets are asset that will be used or utilized or within 1 year. Non-current assets are assets that will be used or useful for the period of more than 1 year. So if you see example here, you see the first one is cash. What do you think about cash? Is it an item that will be used within 1 year or more than 1 year? So cash, most of the time, will be used within 1 year. You have a business, you use cash today, you get cash and you use it again. You get cash from the customer and you pay something. So asset is an example of a current. Cash is an example of current asset because most of the time it will be used within the period of 1 year. It will change hand from one person to another person very quickly. And then inventory. What do you think? You have a grocery shop, you sell many things: bread, sugar, rice, canned foods, etc. So what do you think about this? Are they going to be useful or to be used in 1 year or more than 1 year? So most of the time, remember this, inventory most of the time will be used within 1 year very quickly. If you have a grocery shop today, you sell you purchase items or things from supplier and you sell to customer. Several days later, you purchase again from the supplier and you sell it again to the customer. So most of the time, inventory is a current asset. I do not say all the time, I said most of the time. Okay, and then that is another example of current asset. Account receivable is like this. Let's say you have a business, a customer purchase some products today, something today from your shop. For example, let's say you have a grocery shop and then one customer, he purchased groceries 100 ringgit and he said he will pay at the end of the month. So that 100 ringgit in accounting, you have to record it as an account receivable. Dalam bahasa Melayu kita panggil akaun belum terima ataupun akaun penghutang. So that amount 100 ringgit is or $100 is an asset. Why it is an asset? Because in the future your business will get 100. So that is why it is an asset. So this asset also a current asset because most of the time is a customer owe money from a business, they will pay quickly in less than 1 year, maybe 1 month, maybe 2 weeks. So most of the time. Okay. How about buildings? Building is an example of a non-current asset. because building is useful or will be used in the period of more than 1 year. If you have a business and then you own a building, that building is an asset. But you know that the building can be used for many, many years, 20 years, 30 years, and maybe more. So building and also land and also many equipments and furniture, they are called non-current asset because they are useful for more than one accounting year, for more than 1 year. Okay, remember that. Assets, the definition is, the simple definition is resources owned by a business. Or sometimes we can say that assets are the things that will benefit a business in the future. Okay, so the second element of accounting is called liabilities. Liabilities, the simple definition of liabilities is obligations. Obligation means something that a business will have to pay in the future. So if you have a business, there are several things that you have to pay in the future. So let's see. The first example here is account payable. The second example is tax payable. The third example is bank loan. Okay. So always remember, liability is something that a business has to pay in the future. So or it is an obligation for the business. So the simple example is the bank loan. If you have a business, sometimes your business has to make bank loan or loan from other sources. So a loan or a bank loan is a very good example or typical example of a liability. When you make a loan, when your business make a loan, your business will receive cash, and your business will have to pay something in the future. So let's say you go to the bank and apply for 50,000 loan for your shop, and then you got the 50,000. So that 50,000 that you have to pay back to the bank, or bank loan, we call it bank loan, a bank loan, is an example of a liability. Okay, there are also two types of liability: current liability and long-term liability. Okay, remember this. A current liability is a liability that has to be paid within 1 year. So, for example here, account payable. Account payable is like this. You have a shop. You purchase supplies from, you purchase something from supplier. But you say to the supplier, you will pay next month. Let's say you have a grocery shop, and then you take many groceries or things from supplier, and then you say you will pay the thing at the end of the month. So the amount that you still do not pay to the supplier, in accounting we call it, or we record it in account payable. Dalam bahasa Melayu we call it account belum bayar or account pemiutang. So payable is the amount that you still do not pay to the external party or to the supplier. So that is a liability, and it is a current liability because when you owe something to supplier, most of the time you will pay within you will pay with as soon as you can. Most of the time it is less than 1 year. I said earlier, another type of liability is a long-term liability. Okay, long-term liability is a liability that your business has to pay in the period of more than 1 year. So the simple example is the bank loan. If you borrow money from bank today, 50,000, most of the time you will want to pay back the bank loan maybe in 5 years, maybe in 6 years, maybe in 3 years. So it is a liability that you will have to pay in the period of more than 1 year. That kind of liability is a long-term liability. Okay, and then the third element in the financial statement is called owner's equity. Owner's equity, the definition is amounts owned by the owner of the business. Okay, the thing is like this. Let's say you start a gross you just started a business. That business is a grocery shop. So what is owner's equity? Owner's equity is the amount in the business that owned by you, the owner of the business. The thing is like this. When you start the business, you have to invest cash into the business. So let's say when you started the grocery shop, you take 30,000 from your own pocket, and you use the 30,000 to start the business. So the owner's equity is the 30,000. It means that the amount owned by you in the business, the amount owned by the owner of the business in the business. There are several accounts or several things related to the owner's equity. The first thing is called capital. So the thing that I mentioned earlier is the capital. A person started a business. He put $30,000 from his pocket into the business, or he invested $30,000 from his own pocket into the business. That 30,000 in accounting we call it capital. Okay, so the second thing that is related to the owner's equity is we call it withdrawal. So the capital will increase the owner's equity. When you put capital, you put cash into the business, the equity, the owner's equity will increase. Withdrawal is something like this. Withdrawal, let's say you have a business, you already invested $30,000 when you started the business. That is the capital. But in one day, you need cash urgently. So you take 1,000 ringgit or $1,000 from your business. That thing or transaction is called withdrawal. The owner takes something from the business. So that is a withdrawal. So withdrawal will decrease or reduce the owner's equity. Remember, when the owner of the business put $30,000 into the business, that is capital. Capital increase the owner's equity. Now the owner's equity is 30,000. But when the owner of the business take 1,000 from the business for his own expense, personal expense, then that is called withdrawal. And withdrawal reduce the owner's equity. Before that, the owner's equity is 30,000. When the owner of the business do withdrawal 1,000, now the owner's equity is decreased and become 29,000 only. So capital increases the owner's equity. Withdrawal reduce or reduce the owner's equity. Okay, another thing related to owner's equity. Okay, when there is a business, for a sole proprietorship business, the business is owned by the owner. Let's say you have started a business. You have started the grocery shop. You put 30,000 into the business. So it means that the business is owned by you. Okay, so you have 30,000. Okay, now if the business is making profit, let's say after 1 year the business is making 10,000 profit, then the profit will increase the owner's equity. Why? Because you, the owner of the business, put 30,000 cash. You invest in the business. When the business is making profit, the profit is belong to you, the owner of the business. So if the business is making profit, then the owner's equity will increase. You invest 30,000. After 1 year, the business is making profit 10,000. So now at the end of the year, the owner's equity becomes 40,000. 30,000 the amount you have invested, plus 10,000 the business the profit made by the business. But if the business is making loss, then the owner's equity will decrease. For example, you started a business, you put $30,000 capital. Okay, so that the owner's equity is 30,000. After 1 year of operation, the business is making loss 5,000. Then the owner's equity becomes less, becomes 25,000 only. Okay, so that is the thing related to the owner's equity. So there are 4 things I said. Owner's equity is related to capital. The second thing is withdrawal. The third thing is profit or loss. So, how to calculate profit or loss? In accounting, to calculate profit or loss, very easy. And to calculate profit or loss, the basic formula is revenue minus expenses. You have a business. When you sell something, you will get revenue. And also, when you have a business, every day you have to pay many expenses. Rental expense, salary expense, electricity, water, etc. There are expenses. So revenue you get from selling things minus all these expenses equal to profit. So to calculate profit, the basic equation is revenue minus expenses. So what now we see at the revenue and expenses. Okay, the definition of revenue and expenses. Okay, so revenue. Okay, remember this. Revenue, the definition is an increase in a business resources from the sale of goods or providing of services. Okay, in this course, we focus on sole proprietorship service business. So now we start to use a service business as an example. So the simple one is like this. Let's say you have a laundry shop. So a laundry shop provide laundry services. So what is the revenue for your laundry shop business? Okay, so revenue for your laundry shop business is an increase in business resources from providing of services. So it is like this. Every time you provide laundry service to a customer, and then the customer pay, that amount of payment is revenue for your business. So you have a grocery shop. Today, one customer come. He asks you to do laundry service, and he pay you 50 ringgit. So that is revenue. Maybe many customers come within in a day, so you will get many revenue. Okay, remember that revenue is an increase in company's resources or a business resources from the providing of services or selling of goods for merchandising business. And then okay, the next thing is what is an expense. So definition of an expense. So definition of expenses is amount that a business has to pay in the normal course of business to generate revenue. Okay, to make it simple, the amounts that a business has to pay to generate revenue or to continue its operation. Okay, the example is like this. Okay, now you have a you have a laundry shop. So what expenses? What are the expenses that your laundry shop has to pay? So the example is like is rental. The first example is rental. If you have a laundry shop, most of the time you have to rent the building, the shop building. So every month you pay 1,000 ringgit, for example. So that 1,000 ringgit is a rental expense. It is an expense. The amount that a business has to pay to continue its operation or to generate revenue. Okay, another thing is if you have a laundry shop, you have to hire several workers, maybe 3 workers, to help you to run the service business. So when every month you have to pay salary, let's say 3 workers, total salary every month is 3,300. So the 3,300 is salary expense. What else? Every month you have to pay electricity and water and telephone and also maybe internet connection for your business, for your shop. So that payment is an expense. In accounting, when you have to pay for electricity, water, internet, we record it in one expense account. The account is called utilities account. Utilities expense account. Okay, and then let's say you have operated your business every year. Let's say you have to pay license for your business. So that is also an expense. What else? Salary. And then if you have a laundry shop, maybe every 6 months you have to call technician to clean your machine and to make sure your machine is working properly. So that is something that you have to pay to the technician. That is called maintenance. Maintenance cost. Maintenance expense is also an expense. Maybe after every several months you have to repair your washing machine. So the repair is also an expense. Most of the time we record it in one account, repair and maintenance expense. Okay, so remember that. So if a question asks you what are the elements of financial statement, then you know the answer. The answer is like this. There are 5 elements of financial statement. The first one is asset, second one is liability, third one is owner's equity, number 4 is revenue, number 5 is expense. You can read about this in the textbook. This thing is very important. If I give you a list of 20 items, for example, then you have to know which one is asset, which one is liability, which one is owner's equity, which one is revenue, and which one is an expense. Okay, very important. Okay, this is the third subtopic in in this week lecture. So this subtopic is about subchapter is about the accounting principle and assumptions in preparing the financial statement or in doing the financial accounting work. Okay, principle and assumption is like this. It is like the regulation that you have to follow when you want to do the accounting record. Okay, so when you do something, like you go to the university or you go to the library, you have to follow some rules. And also the easiest example is when you use the library, for example, you have to follow the rules. Before you enter the library, you have to have library card, and then you are allowed to use certain section of the library only. And then when you want to borrow book from the library, you have to produce your you have to show your card. Somebody has to record something, and then there is a date for the return, etc. So these rules have to be followed. If you do not follow the rule, then you will have problem. Same goes to accounting. When you want to do accounting record, you have to follow the rules, or in accounting we call it principles and assumption. If you follow this rule, principle and assumption, then everything is safe. Your accounting record is correct. But if you do not follow the principles and assumption, then problem will happen. Many things will go wrong. Okay, so let's see. Okay, in accounting we have this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12 assumptions, principles, and constraints. So most of the time, all of these things are called principles or assumptions. So it is the same thing. Okay, these are the rules or basic rules that you have to follow when you want to do accounting record. Okay, the first one, separate business entity. Okay, remember this. You have to remember the thing that I will say. Separate business entity means something like this. In accounting, the business and the owner of the business are different entity. Again, in accounting, the business and the owner of the business are different entity. Okay, that is the assumption. And how it affect your way of record of doing accounting record for a business. So when you know that there is a separate business entity assumption or principle, then you know that when you do accounting record for a business, you have to record the transaction related to the business only. The personal transaction of the owner of the business cannot be recorded in the account of the business. So let's say you have a laundry shop. When you do the accounting record for your laundry shop, you record transaction related to your business only. For example, you record revenue, customer pay something to your business, you record it as revenue. You pay salary of your worker, you record it as an expense for your business. You pay electricity for the business, you record it in the account of the business. But if one day you pay 300 ringgit electricity bill for your house, for your own personal house, then you cannot record that in the account of the business. Why? Because there is an assumption of separate business entity. You and the business are different. The accounting record is for the business only, not for your personal transaction. Okay. Okay, that this one. The assumption number 2, going concern. Okay, going concern principle is like this. In accounting, it is assumed that the life of the business will continue in the future. It is assumed that the life of a business will continue in the future, or it is assumed that a business will continue to operate in the future. So, when you do accounting record, always remember, in accounting we have going concern assumption that says the life of the business will continue in the future, or the business will continue to exist and operate in the future. Okay, what is the effect of this assumption on the recording process? The effect is, when you follow this assumption, then you can categorize the asset and liabilities of the business into current and non-current. So when you use this assumption, then you can categorize the asset of your laundry shop. There are two categories, current asset and non-current asset. The liabilities can be categorized into current liability and long-term liability. This assumption allows you to categorize the liability and asset into that category. If there is no this assumption or principle, if there is no the going concern assumption or principle, then you cannot categorize the asset and liability into current and non-current. Okay, you only can categorize that after you assume that the business will continue to operate in the future. Okay, money tree unit. Okay, money tree unit, the simple way to explain about this assumption is like this. In accounting, you record only items that can be expressed in terms of dollar and cents only. In accounting, you record items that can be expressed in terms of dollar and cents only. Okay, so let's say you have a business, you have a laundry shop. The thing that you can record for your laundry shops are things that can be expressed in terms of dollar and cents only. For example, your laundry shop, you have the building, then you can record it. The price of the building or the value of the building is 300,000, so you can record it in your account. Building 300,000, and then you have the land. The land is let's say it is not land. Land is always coming with the building. So and then the next thing is, let's say you have 5 washing machine. Every machine is $5,000. So 5 times 5, you have asset washing machine $25,000. But let's say your business is located in a very good location. So location actually is an asset. It is something owned by the business, and also something that will benefit the business in the future. So can you record the location in your account? You cannot. Even though it is like an asset, good location is like an asset, but you cannot record in your account because location cannot be expressed in terms of dollar and cent. You can record building, you can record furniture, equipment, but location you cannot record. Another thing is like this. Maybe your business has many loyal customer. You have 20 people that always go to your laundry shop. Loyal customer loyalty is also like an asset. But can you record customer loyalty? You cannot, because customer loyalty cannot be measured in terms of dollar and cent. So remember, in accounting, we record things that can be expressed in terms of dollar and cents only. Okay, number 4, time period. Time period is like this. The assumption says, in accounting, we assume that the life of a business can be divided into specific period. Okay. Remember before in the previous slide, we have a going concern principle. The going concern principle says, in accounting, we assume that the life of a business will continue to operate in the future. That is one assumption. And then this one is time period. The time period assumption says the life of a business can be divided into specific period. So the time period assumption allows you to calculate profit for a business. So when you use this assumption, so the life of your business can be divided into 1 month, into 3 months, into 6 months, into 1 year. When you can divide the life of the business into, let's say, one year, then you can calculate the profit. If you do not divide the life of the business, then you cannot calculate the profit. So that's why in accounting we can prepare accounting record for the period of 1 month, maybe 3 months, maybe 6 months, and also can be 1 year. According to the law and regulation, at least a business has to close account once a year. That's why most businesses, all businesses, they have to close the account once a year. Most of the time, they will close the account at 31st of December. They have to calculate their profit. And then they have to calculate tax. Maybe for the owner, and also some for a big business, the business has to pay tax. But a sole proprietorship business, the owner of the business will have to pay tax. Okay, I think we'll stop here, and do not forget to write your metric number in the comment section, so I will take it as the attendance for today's lecture. Thank you very much.